thousands of trucks ready for sale, just sitting unused in lots. There's $867 billion in unsold cars suffocating America's lots right now. And if you're thinking about buying a car in the next 6 months, this could either save you $30,000 or trap you in the biggest financial mistake of your life. Right now, while you're watching this video, dealers across America are bleeding $127,000 monthly in interest costs on cars that nobody wants. We're talking about a mountain of metal built on pure pandemic greed that's now crushing the very companies that created it. Meet Sarah, a teacher from Denver who thought she'd never afford a new truck. Last week, she walked into a dealership and drove off with a $66,000 pickup for $39,900. That's nearly half off the sticker price. But Sarah doesn't know she's part of a much bigger story that's about to reshape how every American buys cars. Because in 2021, dealers flipped the script and turned scarcity into a business model. Empty lots became gold mines. New cars became unicorns. They gouged customers during shortages and laughed all the way to the bank. But now they're drowning in inventory and begging customers to take their losses. "We got too cocky," one anonymous executive admitted to me yesterday. And now everyone's panicking. But here's what they're really terrified. You'll discover this isn't just about getting revenge on greedy dealers. This is about the complete collapse of the automotive pricing system that kept customers powerless for decades. The question isn't whether you can get an incredible deal right now. It's whether you'll know the difference between a genuine bargain and a financial trap that will haunt you for years. In March 2020, assembly lines went silent across Detroit, Kentucky, and Tennessee. The global semiconductor shortage hit without warning, freezing production at Ford, GM, and overnight, the pipeline of new vehicles collapsed. By June, American dealers were running on fumes. Lots that once held 300 cars now had 30. Appoint-only sales replaced weekend crowds. Buyers lined up outside hoping for a chance at anything with 4 wheels and air conditioning. The supply shock wasn't just about chips. Cargo ships stalled off California, containers piled up in ports, and essential parts, wiring harnesses, sensors, even basic plastics vanished from the supply chain. In 2021, Toyota's U.S. factories ran at half capacity for months. Ram shut down its Warren truck plant in Michigan for weeks at a time, sending thousands of workers home. The numbers tell the story. U.S. vehicle output dropped by more than 2 million units that year, the sharpest decline since World War II. For the first time in decades, dealers had nothing to sell. Some brands, like Honda and Subaru, rationed inventory to their best-performing stores. Even the nation's largest dealer groups started hoarding what little stock they could get. Appointment books filled up weeks in advance. Test drives became a privilege. The old rules, negotiate, wait for a deal, shop around, no longer applied. If you wanted a car, you had to act fast, pay sticker, and maybe throw in a few thousand extra for the privilege. This was the first domino. Scarcity became the oxygen dealers needed to breathe. But behind the scenes, the chaos of empty lots was already planting the seeds for something far more dangerous. A new kind of leverage, where every missing truck or SUV became a weapon in the hands of the people who controlled the supply. Dealers didn't just ride out the storm. They turned scarcity into a weapon. Price tags became starting points, not limits. Walk onto a lot in 2021, and you'd see a $7,000 market. Adjustment sticker slapped next to MSRP that wasn't a typo. On popular trucks and SUVs, markup soared past $10,000. Sometimes $20,000 or more. You wanted a new Ford Bronco. That meant paying $15,000 above sticker or walking. Even basic models weren't immune. Toyota Corollas and Honda Civics. Once the safe bet for bargain hunters came with $3,000 to $5,000 in mandatory dealer ADA. Window tint, nitrogen-filled tires, security etching, paint protection you never asked for. Try to say no, and the sales script kicked in. That's just how it is right now. Someone else will pay. Forced bundles became the norm. Dealers packed every deal with extended warranties, prepaid maintenance, and anti-theft devices, often adding $2,000 to $4,000 to the out-the-door price. Refuse, and the car was suddenly sold or unavailable. Some buyers reported being told flat out, if you don't take the package, we'll move to the next person in line. Bait-and-switch tactics exploded. Online listings advertised one price, But in the finance office, the numbers changed. Hidden dock fees, reconditioning charges, and appearance packages appeared on contracts at the last minute. According to consumer watchdogs, 71% of used car buyers face these tricks, losing billions in surprise costs each year. The playbook was everywhere from coast to coast. Domestic brands led the charge. Ford, GM, and Stellantis buyers faced hidden fees on 7 out of 10 deals. Imports weren't far behind. Even luxury brands, usually above the fray, joined in with their own exclusive adjustments. All of it was by design. Dealer groups held meetings to compare who could squeeze the most profit per car. Sales teams got bonuses for holding the line on price and pushing ADA. Internal emails leaked to reporters called it maximizing the moment. For the average buyer, it was open season. First-time shoppers, young families, anyone desperate for a car, they paid the highest price. The system was rigged, and the house always won. But the gold rush came with a cost. Every extra dollar squeezed from buyers planted the seeds for the collapse, now sweeping across America's lots. Inside the boardrooms of Detroit, the mood was triumphant. Minutes from Ford's 2021 strategy sessions show executives openly celebrating what they called a margin revolution. Gone were the days of chasing volume at all costs. The new mantra, sell fewer cars, make more money on each one. Jim Farley, Ford's CEO, told investors, "We are never going back to the old way. Lean inventory is good for profits, good for the brand." That wasn't just talk. Ford's gross profit margin soared to 9.85% in 2021, more than triple the year before. General Motors posted $10 billion in net income, selling 13% fewer vehicles. On Wall Street, this was gold. Analysts cheered as GM's CFO explained, "We're not returning to pre-pandemic inventory levels. Running tight means pricing discipline." Investor calls sounded less like auto industry updates and more like victory laps. Stellantis' Carlos Tavares put it bluntly, "We are going to limit our stock. That gives us more pricing power, less volatility, and better profitability." The plan was clear. Keep supply tight, keep prices up, and squeeze every dollar out of every truck, SUV, and crossover rolling off the line. Board presentations tracked not just cars built or sold, but average transaction prices and dealer compliance with margin targets. Want to avoid the 17 car brands that will cost you the most money in 2025? Download our free ebook, Avoid the 17 Car Brands You Need to Avoid in 2025, and protect yourself from the biggest automotive money traps. Link in the description below. Internal memos, paraphrased in trade reports, described controlled allocation as the lever for maximum profit. Dealers who played along with the new rules, pushing add-ons, holding the line on markups, were rewarded with premium inventory and factory bonuses. Those who discounted too soon found their pipeline drying up. The language was clinical, almost cold. Optimizing inventory to enhance pricing power, structural capability for disciplined supply, but the intent was unmistakable. Scarcity wasn't bad luck, it was policy. For the first time in decades, the industry's leaders were united in their refusal to flood the market, even as American families were priced out. One executive off the record summed up the mood. "We finally have the upper hand. Why give it up?" The gold rush was no accident. It was a boardroom decision executed with ruthless precision. And while the profits rolled in, the foundation for today's crisis was being laid in plain sight with the full blessing of every shareholder in the room. Software, not just scarcity, kept the price spiral alive long after the chip shortage faded. Allocation algorithms, lines of code written in Detroit and Silicon Valley, decided which cars reached which lots and at what pace. Dealers who played by the new rules, holding firm on markups and pushing high-profit add-ons, got rewarded with early shipments of popular models. Those who discounted too soon found their orders quietly delayed or swapped for slow-selling base trims. It wasn't just about moving metal. It was about enforcing discipline, one delivery at a time. The system ran deeper than most buyers ever realized. Automaker portals tracked every transaction, flagging stores that slipped below target profit per unit. Sales managers logged into dashboards that ranked them against peers, color-coded by compliance with factory pricing policies. A single click could see a dealer's next batch of trucks, replaced with sedans nobody wanted. For the first time, wholesale supply was a weapon, and the software held the trigger. Incentives, too, were rewritten. The old bonus for selling the most cars in a region scrapped. Now, the fattest checks went to dealers who moved luxury trims and loaded options, models with the highest sticker and the biggest margin. Entry-level cars, once the backbone of the business, became afterthoughts. By 2023, more than half of all new vehicles shipped in the US carried premium packages or top-tier tech. The number of affordable models on lots dropped by a third in just 2 years. Suppliers felt the squeeze as well. Orders for basic seats, steel wheels, and cloth interiors dried up.